Okay, let's begin. First of all, thank you all for your time today. If you cannot hear me, please send a message in chat. What we're going to do today is cover two new changes to the to CorpWorks, share redemptions, and also the new CDA loan feature. I want to start with CorpWorks, and we'll look first at the share redemption change. So you can see that I've created a solution with some preferred shares that DEF has outstanding that are actually owned by Bill Smith. And the one thing that I wanted to touch on before we dive into the actual share redemption, I want to make sure that when you are modeling estate freezes where preferred shares have previously been issued, so not something that's going to happen in the future. If you're going to issue preferred shares in the future, against an estate freeze that's going to happen at some point in the future, then what you would be doing is redeeming the existing common shares and issuing new preferred shares, but at some future date. So what I want to touch on is just the situation where your file has preferred shares outstanding that were previously issued because of an estate freeze. So first of all, I want you to notice that the issue price is going to be the same PUC as the original common shares. But the important thing is that once you've entered those preferred shares, you need to right-click on the entry and make sure you left-click previously issued due to estate freeze and the estate freeze checkboxes. And this requires two right-clicks. So right-click, select the first checkbox, the menu will close, right-click again, select the second checkbox. And when you do that, what will happen is that under equity, the preferred shares that are outstanding will show as a liability because they represent, an obligation of the company at some point in the future to redeem those preferred shares. So I noted that the value, the PUC, is the same as the common shares. But if we go down now to tactics, what you'll want to do is you'll want to put in a value for the preferred shares that reflects the value of the common shares of the company at the time the common shares were replaced with the preferred. So, when the preferreds are redeemed, whatever the value of the common shares were that the shareholder owned, you're going to put in the value of the preferred shares to reflect that. So now you've got the actual value of the preferred shares as far as the shareholder is concerned. The change that we want to look at today is on the Capital Changes tab, and I've put in a redemption of 500 of 1,000 shares that are outstanding. So I'm just going to click the Edit button, and I want you to notice this is the new feature, and it's the ability to treat the dividend as either a CDA eligible or ordinary dividend. This was something we weren't doing before. All dividends are, as a result of a redemption, were treated as ordinary dividends, although there was a checkbox that allowed you to treat them as eligible dividends. Well, it turns out that they can be treated as CDA eligible or ordinary. So I'm just going to jump down to dividends, and I want you to notice that I have nothing in the CDA account, no value entered into it. You can see here, no value. I have just a $5,000 GRIP pool. I wanted to, keep that small, and then you'll notice a lot available for the payment of ordinary dividends. So if we go back, and we have a look now at this order, we'll see that it's saying, first, if available, pay out the dividend as a CDA dividend. Once all the CDA account is used up, then pay the dividend as an eligible dividend, and once that's used up, then pay the GRIP pool is used up, then pay the dividend as an ordinary dividend. So obviously this is the preferred order from a tax point of view. So notice it's eligible, then ordinary. So if we go back now to dividends, what you'll see is there's no CDA, we notice that, but the eligible dividend pool is being used. So notice these are new columns. So we have the GRIP pool, and then it says preferred share redemption, so that this can be evident to you, and then GRIP after redemption. So there's no redemption in 2020. I modeled the redemption in 2021 for $50,000. So what's happening is the order that we set said use the GRIP pool first to the extent that there is any. So we've used, of the $50,000 redemption, we've used $5,000 from the GRIP pool. And then if we go down to ordinary dividends, you can see the balance is coming from the ordinary dividend pool or pot. So if we just go back here to the capital changes tab, and if I select edit and I change that to make it ordinary dividends first, then what we'll see is, again, no CDA account, but we'll see that the eligible dividends, there is no redemption of them because we made ordinary first, and there's more than a sufficient amount in the account to be able to pay out the redemption as an ordinary dividend. So you get to select the order and then experiment with things, and clearly, you know, if there's a CDA account, there may be quite an advantage to making it first in the list. So that was one of the features that we've added, is the ability to determine the type of dividend. The second thing was this whole issue of a CDA account and having it paid out as a shareholder, paid out every year, and then a shareholder loan. So I'm going to switch to the CDA loan solution, and I have a similar solution in CorpWorks. And the feature that we've added, if we go to actually ABC and we go to dividends and ordinary dividends, is the ability then, sorry, it's not what I want CDA, I apologize. We have the ability then to pay out the CDA account every year and do it as use the shareholder loan mechanism. So just to give you some background, what I have for ABC is a portfolio that has $1 million in it, and I made, so our math is easy, I made a capital gain return of 10% and a turnover rate of 20%. So what's happening then every year is on the $1 million, we've got a $100,000 capital gain. Turnover rate is 20%, so 10%, or so $20,000 of capital gains are being realized every year. And then, of course, half of that is going into the CDA account. So if we move over and have a look at it, you'll see then that the first year it's $10,000, so or 20,000 times 1/2. But notice also it grows every year because there's a certain amount that's retained within the company and causes, you know, additional growth. So with the shareholder loan checkbox selected, the idea is to crystallize the CDA account every year, so that if there are years when there is some kind of loss, capital loss, then that doesn't reduce what could be paid out as a result of previous capital gains. So literally all it is a matter of selecting the shareholder loan checkbox, and I've used pay all, so I just want to pay it out every year. And then what happens is the software automatically creates a shareholder loan. So this is a loan from the shareholder back to the company. So notionally what's happening is the CDA dividend is being declared. It's notionally being paid out to the client. The client is then lending the money back to the corporation. So the corporation now has a loan outstanding in the amount of the CDA. And I've applied an interest rate to it. So now if we go down and we have a look at the equity of the corporation, what we see is that CDA loan. So year 1, 10,000, year 2, 21, year 3, 33,1, and so on. And then also if we go to net cash and we have a look at uses, we can see the interest payment on that CDA loan at the 2%. Now, if we go over to VisionWorks, and this is the thing that you'll need to be careful about, I've got the CorpWorks and VisionWorks files linked, and you can see that Bill owns the ABC common shares. But the key thing you need to do as well is go to the Loans tab, and you need to select Bill here relative to that loan that he makes to ABC Corp, so that the loans are then connected, both as a cash source for Bill. So if we go down now and have a look at the income, we'll see that he's receiving that interest from the loan. And then if we look at income assets, then we'll also see that the loan that he makes is an asset for him. In CorpWorks, if you at some point want to pay down that loan, then you would go to pay downs, put in some value. I'm just going to make it $50,000 in 2025. It'll make it nice and round. And now if I go back and look at equity, what we'll see is that the shareholder loan declines in 2025 as a result of the $50,000 repayment. And if we relink to VisionWorks, we would see that Bill is, of course, receiving that $50,000 loan repayment in 2025. What I would like to do now is have you unmute yourself and ask any questions. And to unmute, you just press *6. So I'll let each person do that and then, ask questions.
Oh, hi there. This is Aaron. Can you hear me okay?
Yes. Mm-hmm.
I just had a question about the preferred shares and the paid up capital. Is it possible if you go into about in the capitalization screen, can you just edit the paid up capital in that screen as opposed to going to the valuation?
Oh, yeah. Let me go back and explain that. Sorry, I'm in the CDA loan. Let me switch solutions.
Sure. Thank you.
There's a little bit of misunderstanding there. So I want to go to the preferred share redemption. So where are we? DEF. The paid up capital, this is where you're going to put in the PUC. So as you know, when shares are redeemed, the original capital contribution that was made is returned to the shareholder without any tax implications, right? It's the original capital that seeded the company. So the PUC stays with the preferred shares based on the original common shares. So that's the original low value that gets to be retained or returned with no tax. But what you need to do here under valuation is you need to put in what are the value of the preferred shares now at the time of the, or were the value of the shares at the time of the freeze. That represents the growth in the value of the company over that period of time. So there are two different things. The About page is the PUC, and here is where we put in, but now what's the company worth?
That makes total sense. The other question I had was, if you go to the capital changes and I think there's a field that allows you to assign a value for the disposition of those shares. Would that work as well, or should you not do it like that?
No, this is essentially going to be, it should be the same as the valuation. So you can see, sorry, I have to close this. So on the valuation, we have $100 per share. So on the redemption, it's $100 per share. That should be completed automatically. If for any reason you wanted to override it, then you would select the override checkbox.
Perfect.
But
Thank you so much.
The value at the time of redemption will be, the number of shares, and the preferred shares are just going to be, a constant value over time, right?
Yeah, absolutely. Thank you.
And anybody else with any questions?
Hi, Michael.
Ed, yeah, hi, Ed. I see you're on the call.
This is fantastic. Everything I wanted. I just want to confirm on that repayment of the capital on the loan balance, that's tax-free coming to the VisionWorks individual, right?
Yes, because it's coming out of the CDA account. Yes.
Perfect.
Yeah, no problem at all. Of course, it's a loan from the shareholder, so when it goes back to the individual, it goes back tax-free because it's just repayment of a shareholder loan. Other questions? So I would like to ask a question. I've suspended the training webinars, although I'm going to start them again next week, just the general webinars, looking for topics, whatever you might have in mind. But the other thing is, in the current circumstances, I am wondering if I should be doing 2 or 3 webinars a week, just starting with VisionWorks and working our way through. If you're finding that with the isolation, if you have the time, the availability, and we can use the time productively for just general training. So I'd like to hear from anybody that has any thoughts about that, if you think that would be worthwhile.
Seems like everybody's got a lot more time on their hands these days, so some added training probably wouldn't hurt.
Yeah, well, it works for me. Here are a couple of chat comments, so let me see what this says. It would be great to do 3 webinars a week. Somebody else said that would be great too.
Hi, Michael.
Yes, hi.
Yeah, it's Peter here. Yeah, I agree. I think that we have some more time on our hands, and quite frankly, in order to be proficient with your software, one has to use it constantly, and we don't. We use it from time to time, and it would be good to keep up on everything.
Okay. So what I might do is I might start with 2 webinars a week. I'm thinking Wednesdays and Fridays, and see how that goes. What I would like is any suggestions as to what topics we should cover. That would be useful. So if you can shoot me an email, but what we might do is we might just start right at the beginning. I know it's very simple stuff, but we might start right at the beginning, just once more review, the retirement assessment questionnaires, the importing, the things that I would do to make the plan a little more valuable to the client. We talked about making sure we add vehicles. We're not always going to be driving 2 vehicles until we're 95, making sure that our general expenses don't include, for example, vacation expenses, any big ticket items that we imagine that we separate those. We're not taking vacations at the same rate when we're 95 as when we first retire. So we might do a general review of some of those things, and then go from there to retirement and estate assessments, go back once again, review wills, once again review the insurance calculations, then go from there to financial plans, life plans, and then work on corp works and trust work. So I might just take it right from scratch. Peter's asking, so a lot about the presentation of output. Okay, so maybe we'll start with output rather than the inputs. And then somebody else is suggesting TrustWorks. So let me just catch some of these chat messages here. So someone asked about TrustWorks, very similar to to CorpWorks. Someone else is asking, starting right with basics and then progressing from there. And then again, output options. And then somebody suggests 1 basic and 1 advanced each week. So why don't we do that? Why don't I do 2 a week? I'll make Wednesdays basic. I'll make Fridays advanced. And where we'll start with the advanced is with output. So we'll do that starting next week. So if anybody has any more questions about what we covered today, let me know. Otherwise, I wish you a good weekend.
Michael,
yeah.
I just have one quick question. Is there a way in CorpWorks to put a capital loss that would apply to this year, or is it just a sale of the portfolio?
No. If you go to tax, other, let me see, is it accrued? Yes. What this shows, so because VisionWorks or CorpWorks and TrustWorks are prorating, if anything has been earned earlier in this year, or if there was, for instance, a capital loss earlier in the year, or let's say a charitable donation made earlier in the year, a charitable donation, we don't want to model it now if it was made earlier, because that would represent a cash flow item, but it's already happened. So we need to know that it's happened for tax purposes, et cetera. So this is where we can put in the accrued, including capital losses from earlier in the year.
Perfect. One other question, I just want your philosophy on this. Like when we're using long-term rates of returns, if we're building a plan today and the portfolio might be off 20% from where it was a couple months ago, still using the conservative long-term rates of return, or do you think using a higher rate of return in the near term to get back to normals makes more sense? Just your philosophy on that.
I would be hard pressed to say. I would be inclined to say from lower levels, better returns. From the higher levels, not so optimistic returns. That would be my personal feeling, but, and because central banks have poured tons of money into the system, and it looks like governments will be doing a lot of, other things as well. So, overall more money, good for the market. So that would be my feeling. Higher return, sure. And keep in mind, one of the things also is that in everything we do, all entries are dynamic, meaning they can change over time. So there would be nothing that would preclude you from putting in a higher rate of return than you might normally use for a couple of years, and then scaling back at that point to something that would be, the more standard longer term return. Anybody else? Well, thank you, and we'll look forward to starting the webinars next Wednesday, and we'll start with basics. Thanks.
Thanks, Michael.
Thank you.
Thank you.